Nissan Joseph, Chief Executive Officer at Metro, joins in. Morning, Mr. Joseph. Thanks a ton for joining in. Mr. Joseph, we were talking just before we came to you in the break. You did say that the numbers were actually pretty good and better than what you'd have liked. But the markets at this stage, Mr. Joseph, don't seem pleased. The stock is down 5%. Would you help our viewers and investors understand more about what went on in the quarter for you?
Sure. Samina, good morning, and thank you for having me. I think when you look at our numbers of 33% EBITDA, or you're looking at a 17 plus percent PAT, those are numbers that most retailers would yearn for, right? And I think in our footwear industry, we're definitely best in class with those numbers. What you're really facing, and I think what people are trying to read behind, is the fact that we're going against a COVID bump from last year. So last year, there was a lot of pent-up buying, wardrobe refreshes. A lot of things were happening last year with the consumers, and they weren't traveling as much. You look at people, they're out traveling today, they're watching movies, as we saw in IMAX's numbers, right? So they are out doing more things than they did last year, and they're not refreshing their wardrobes, and there's no pent-up buying happening. So when you compare it against last year, of course, it causes some people to raise an eyebrow or two. However, if you look at the trend that Metro Brands has had over the many, many years, right? We've grown our profits consistently, both in a rupee value, but also at a percentage. We've maintained our EBITDA north of 37%. All our numbers are actually north of the guidance that we've given. So I'm quite pleased with the quarter. And, unfortunately, this COVID bump from last year continues through this quarter as well. So we're not going to see a normalization of those numbers till Q1 of fiscal 25, right? So then we start getting normal numbers that you can use the same metrics. In retail, everybody looks at comparables to last year, which I think is usually a good number, but comparing it to last year, the year of the COVID bump, is probably not the best way to look at it. I think one should look at the fundamentals of the business. Our gross margins, when it comes to product, is at 60%, which shows that the consumer appreciates and wants our product, and there's not a slowdown in it. When you look at our EBITDA, it's north of 30%. It's actually 33%. And then when you look at our PAT, it continues to be north of what we guided to. We guide to 15 to 17%, Samina. So overall, I'm quite pleased with the numbers.
Indeed, in fact, it's a stable company, and I think that's what matters. You've delivered quarter-on-quarter growth over the historic past and also paid dividends. So the couple of things that actually stand out for Metro. Let's talk about margins, Mr. Joseph. The EBITDA margins have declined about 300 basis points. Is this because of your net margins that you're getting on your products, or is it operational efficiency expansion that you're investing in which is impacting your margins?
So I think it's a couple of things. One of them is the deleveraging. As sales aren't coming in at the same rate, you get a little bit of deleverage there. That's number one. But number two, there's two other factors. One of them is the Ind AS accounting that impacts us in the EBITDA, the way we have to account for it, especially with the number of new stores we've opened. We've opened north of 80 stores this year, right? So that kind of also takes a little bit of a toll, I think somewhere in the 60 basis point hit there. And then also, we are now back to business as usual. So our expenses are all fully happening. We're not doing many more Zoom meetings. We're actually getting down in person to see stores, to have store managers come here and visit us. We're also investing in technology and talent, and we're trying to make sure that we set the company up for continued growth to ensure that we have the kind of performance that we've done in the past that continues to grow as we go to the future. So while there is a little bit of degradation on the EBITDA, let's not forget it's still 33%, which is north of the 30% that we guide to.
No, I agree. I think it's better than what you've guided for. I think we're just spoiled after seeing the kind of margins we have for Metro in the past. Talk to me about expansion. How many new stores have you added this quarter?
Yeah, so we've added north of 80 stores this quarter. We closed the quarter with 826 stores. And I'm just talking standalone numbers because, the Cravatex numbers can be quite dilutive in some ways as we go through the cleanup of Cravatex. But we closed with 826 stores. We guided, Samina, that we would open 100 stores for 2 consecutive years. And we're already north of 80, so we're well on our way to crossing the 100 that we said we would in this fiscal year. And next fiscal year, we hope to open an additional 100 plus stores. That is not counting our Foot Locker and our Fila stores, right? And as you know, both of those have immense opportunities in a country that is just starting to get active, that is starting to lean towards athleisure and sneaker culture.
Right. I want to talk to you about the new growth engines. I think that's what the markets would like to know more about as we, of course, trying to look ahead. Fila and Foot Locker, that's the big bet Metro is making. When is this going to start turning revenue accretive? And also, what is the expansion plan there? What sort of top-line contribution are we expecting from both these international brands in the near to medium term?
Sure. I think, first of all, let's not forget we have immense growth opportunities in our Metro shoe stores, in our Mochi, in our Walkway, and in our Crocs stores. So we have immense growth opportunities in all those four verticals, right? So, but having said that, what we are excited about also, not getting or taking anything away from our existing amazing business opportunities, is that we have two new brands of Fila and Foot Locker to add to that portfolio. The two things exciting about both of those is that one, it gets us into an athleisure space. A space that we thought was a white space in our portfolio of brands, a space that we predict is going to be the fastest growing segment in the footwear business in the years to come. So that's one part of it. And the second part of it, obviously, it's new to us, right? So it is something that we're now going to be able to add on to what we have. Looking at the growth plans, this year Fila is going to be quite an investment, as I call it. It's a drag on our performance, but that's okay. It's a long-term, multi-decade agreement with Fila, right? So like everything we do at Metro, it's not about this quarter or next quarter. It's really about what's right for the long term of the business, the continued growth, the sustainable growth, and that's how we want to set it up. So this year has been quite the cleanup year for Fila and will continue to be this quarter as well. It'll continue to be a little bit of a drag on us. However, starting in 25, it's not going to be dragging us. And towards the end of 25, it's going to probably be not a drag at all or not dilutive to our earnings at all by the end of 25. In 26, we actually expect Fila to be accretive to our existing numbers, right? So that's when you'll also see us accelerate. So this year has been cleanup, next year is reposition the brand, and the third year is accelerate the brand, right? And from there on out, we can keep growing that. Speaking of Foot Locker, we are hoping to open 4 to 6 stores in Q3 of this coming year. So somewhere around the October timeframe, we should be starting off. We want to stay very focused on our growth. It is a very premium product that Foot Locker has in their stores. It's a very premium retailer. We want to make sure that we build it correctly, so we're able to capitalize on the backside of that growth. And that as well is a multi-decade agreement, right? So we do like long-term relationships with our partners, and we support that. Foot Locker, I think, has the opportunity to be in every major city with multiple outlets in India in the next 3 to 5 years. So those are the kind of the runways we're looking at.
So Joseph, another quick one. Is Fila and Foot Locker better margin products?
So Fila is definitely is accretive to our numbers, will be accretive to our numbers. Foot Locker is a different structure altogether, right? It's a retailer that sells third-party brands. And what that does is, brings in it'll bring your ROCE numbers in. It'll help the other aspects of our business. The EBITDA should continue to not be a drag on us at all. But it is a totally different business model, right? Fundamentally, Samina, there's not many businesses out there in retail that do 17% profit, 33% EBITDA. So, when you look at something accretive, it's not that it's going to be, when you look at adding on another vertical, it's not necessarily going to be accretive, but the synergies that it brings, the learnings that it brings, the optimization of scale that it brings, the ability to get better deals in rentals, all of those have a trickle-through effect throughout the entire Metro Brands portfolio.
So Joseph, one quick word. I know you're picking up international brands, partnerships for the India market. Any global plans very quickly before I get told off by my producers?
You know what? None. There's too much opportunity in India. We have too many options on our plate that we need to focus and maximize this. And I want to make sure that the management team here is absolutely focused on taken advantage of India's growth story. So if we do have an international plan, it'll probably be in the year 2050, 50. So.
Right. Thank you, Mr. Joseph. Congratulations. I guess the going is going well for Metro. We'll speak to you soon and have a more detailed conversation on your business.